Hey everyone, welcome back to Kelly's Take 2 Pre-Licensing Zoom review. Today we're going to start diving into a review of the finance chapters. If you're using the Dearborn textbook, edition 10, this would be units 14 and 15. And shoo-wee, they are doozies, let me tell you. So it's probably going to be broken up into multiple parts. So let's get ready to dive in. I want you to know that I am going to actually be referencing the brand new course syllabus that Deborah Carpenter from the Real Estate Commission just published for us, and it is spectacular. It's a really wonderful study guide. So you'll see me glancing off to the side because I don't have this, 100 and something page document memorized. So I will be glancing over at it, using it as a reference. All right, let's get ready. First of all, you want to know that tons of vocabulary in this unit. I am not going to go over every single vocabulary word with you right now because it's too much. So in your Google folder, you will find under the Unit 15 tab a worksheet on vocabulary. So go ahead, make sure you do that. If not, I'm going to say a list of vocabulary words that you need to go back and make yourself a flashcard for each one. So get ready. And if you need to pause and rewind, isn't that just the beautiful thing about YouTube? Okay, so let's go. So right out of the gate, you've got some level 1 terminology that you need to know. Level 1 is just vocabulary. So know what I mean by principal and interest, amortization, debt service, just another word for your loan, your PITI, principal, interest, taxes, and insurance, equity, usury, very basic on usury, discount points. Remember that 1 point equals or will cost the borrower 1% of the loan amount per point, and that each point decreases where the borrower can buy down their stated interest rate by 1/8 of 1%. And conversely, because the borrower is paying interest essentially in advance, it increases each point that the borrower purchases, increases the lender's yield or effective yield. Yield is the word for profit, by 1/8 of 1%. So know that yield means profit. That's another vocabulary word. No loan to value, no loan to value ratio. We covered that in the math review the other day. Know some calculations, which we also covered in the math review the other day. All right, and let's go on. More terminology. You want to know the difference between a mortgage and a deed of trust. So you want to know what a mortgage is and a deed of trust. You want to know what a promissory note is. I will go into each of those actually in just a little bit. You need to know the definition of hypothecation, lien theory versus title theory. We are going to go over that in just a minute. What it means to default on a loan, and what's happening in a foreclosure. How does that operate? All right, so next we're going to talk about the mortgage note. The mortgage note, Deborah Carpenter calls it the mortgage note a lot in the syllabus. In your book, it's mostly called the promissory note. So the promissory note and the mortgage note, I'm getting used to that as well, right? So just kind of get used to those two terms being used interchangeably. When it comes to a promissory note, also called a mortgage note, this is a promise to pay. This is where the borrower is saying to the bank, I promise on my mama that I'm going to pay this debt. I'm going to pay this loan back. Only the borrower signs the promissory note. The promissory note is a contract, is a type of a contract. Apparently, this is new to me. Here comes some new information. Apparently, in some states, they will use something called a bond in lieu of a promissory note. I had to Google it. Y'all had to Google that right up, okay? And after me Googling it, all I'm going to tell you is It may show up on the national side of the test being called a bond instead of a promissory note. I haven't seen that come up on my PSI practice exams, but you never know. All right, now part of the promissory note will be certain conditions, also called provisions. One, you know very well, and I've had this come up on my PSI practice test a million times, as the acceleration clause. So get that definition down. The acceleration clause allows the lender to call the note, could be called the mortgage note, could be called the promissory note. The acceleration clause allows the lender to call the note in due and payable. How fast? Immediately, right away, ASAP. Okay. The promissory note could contain a prepayment penalty clause, possibly. Could also contain a due on sale clause, but not if it's an FHA or a VA loan. FHA and VA loans are assumable, so they will not contain a due on sale clause. A due on sale clause is there to prevent loan assumptions. If the lender finds out a loan assumption may take place, that could trigger the due on sale clause to be enacted, which will trigger the acceleration clause to be put into place as well. But your FHA, VA loans do not have an alienation clause because those loans are assumable. Certain conditions have to be met, yada, yada, but they are assumable. Okay. Now, most promissory notes are negotiable. That means they can be sold on the secondary mortgage market. Just whipping through the syllabus here. Okay, let's go. All right, let's talk about the mortgage itself and the deed of trust. So if you live in a lien theory state and it comes down to almost 50-50, it's the state's kind of way heavier, just a little bit on the lien theory side of things, but there are a good number of states that practice something different, and North Carolina is one of them. But let's hang out on lien theory for a second. Why is it called that? I don't know. That is a great question. I don't know. It's weird. So it's some weird wording. So lien theory, in a lien theory state, the mortgage is a two-party debt instrument, and you have the mortgagor, OR, is the borrower. Now I know it seems weird, but when you write it down, write mortgagor with an OR and then write borrower with an OR. That'll help you connect it because people frequently mess this up. So one party is the mortgagor, that's the borrower. The mortgagee is the bank. The mortgagee, remember, is if the word ends with EE, somebody receives, how do they feel? So happy. And in this case, it's true because the bank is making what? Money on many different levels. Nice. Now I'm going to read you a special note from Deborah, and so we make this clear distinction. It says, note, the term mortgage is commonly used incorrectly to refer to the actual loan versus the legal instrument that pledges the property for the loan. All right, so your mortgage is going to pledge the property as security for your debt, for your loan. Same with a deed of trust, depending on where you live. North Carolina is a state where we use a deed of trust. The deed of trust is placing the property or pledging it as collateral for the debt. That means if you don't pay your debt, you don't pay your loan, the bank can foreclose on you. Okay, so let's go back to what Deb said. She said, oftentimes people get these confused. So, and use it incorrectly. They incorrectly refer to the actual loan versus the legal instrument that pledges property for the loan. Meaning, quote, I am going to get a mortgage versus, here's the correct way you would say it, quote, I am going to give a deed of trust to get a mortgage loan. And we're expected to know these technical differences, especially for test purposes. All right, now let's keep going. So again, if you live in a lien theory state, you're going to get a mortgage. It's a two-party debt instrument pledging your property as collateral for the debt. If the lender decides to foreclose on you, the lender will have to actually file a court case or go through civil action and take you to court, actually sue the borrower in order to foreclose. Whereas in other states like North Carolina, other states that practice title theory, in that situation, the debt instrument, the deed of trust, has three parties involved. Here we go. Number one is called the grantor. The grantor is the borrower. So again, I know it's weird, but just to help you get it right on the exam, spell borrower with the OR at the end. The grantor is the borrower. Number two, the trustee is the attorney. And number three, the beneficiary is the bank. So three parties there. Now, in title theory state, part of this instrument will contain a provision called the power of sale clause. The power of sale clause allows the bank to foreclose on the borrower. No fuss, no muss. What happens? Well, all the bank does is call me on the cell phone. Call me on the cell phone. No, not Drake. The bank is going to call who? The bank is going to call the attorney, the trustee, to say, hey, so-and-so quit paying their mortgage. Let's go ahead and get the ball rolling. Take this property. Let's foreclose on it. And that's it. Now, the borrower will be called into a meeting in this situation with the trustee, the attorney, and we'll have a period of time. I don't know what that period of time is. It's not in your book necessarily, but we'll have a period of time to redeem themselves. What does that mean? Cough up the cash. Cough up the cash. That's what they need to do. They need to get right with their payments is what needs to happen. So that's called, that time period is called equity of redemption. All right. Now, if you've been taking the Learn, Test, Pass practice exams, I tell you what, they love to ask you about that equity of redemption. So now you know that's the borrower's little time frame to get right with their payments and get up to speed, back on track. All right, let's keep going. Let's see what else is in this syllabus right here. Okay. This is interesting. Who is signing such things? Let me read this to you. If husband and wife are buying as tenants by the entirety or joint tenants in other states, and only one spouse signs the mortgage note. Okay, now let's replace that with promissory note. Okay, let's go again. If husband and wife are buying as tenants by the entirety, joint tenants in many other states, and only one spouse signs the promissory note, both spouses must still sign the mortgage or deed of trust. Because remember, the mortgage or the deed of trust is what pledges the property as collateral for the debt. Very good. All right, now the borrower has a few rights. The borrower has the right to possess the property and to use the property, which in our state, which practices title theory, the borrower, the buyer, would have equitable title. The trustee is actually holding the title in hand until when? Until that debt is paid off completely, until that note is completely paid off. Once the debt is completely paid off, then the borrower will obtain legal title automatically. No fuss, no muss. It bounces back just like that. And this is called the right of defeasance. So if you see that word defeasance, that is a provision stating that the borrower will get legal title once all the mortgage payment terms are met. And of course, that seller or borrower will want to file a satisfaction of mortgage at the Register of Deeds office. We are doing so great. Are you hanging in there with me? I can tell that you are. All right. Now, the mortgage lender also has some rights. They have the right to foreclose on you. Okay. And they can take you to court. That's called judicial. That's in a lien theory state. They could start the foreclosure process on you using the power of sale. That's in a title theory state. And then how do things work when it comes to the foreclosure process? Well, first, the borrower is going to be given notice of foreclosure. Again, they're going to have that equity of redemption time period where they can come in and kind of get it right. If they can't get it right, then we're going to move to the next step, which is to sell the property at public auction. We are going to disperse the money from the sale of the auction. First of all, we're going to pay the cost of sale. That comes right off the top. And then we're going to pay the liens in order of recordation. Naturally, which lien gets paid first? You knew it. Of course you knew it. You know that the property tax lien, along with any special assessment, will get paid first, and then liens in order of recordation. Typically, the main mortgage will fall in line there. Now, if the bank does not make all of their money back from this foreclosure sale, guess what they can do? Just gonna take salt and rub it right in the wound. Just salt right in the wound. Why? Because they can file what's called a deficiency judgment against the borrower to make up the difference. A deficiency judgment is a general lien that's going to stick to all of the assets belonging to that borrower, which could be things like their boat, a horse, their house, for instance. Everything and anything will need to be liquidated in order to pay that deficiency judgment. Now, in North Carolina, if the seller is financing, if the seller is acting like the bank, they're not allowed to do or claim or put forth a deficiency judgment if their foreclosure comes up short, shall we say. Okay. The mortgage lender also has the right to sell or assign your mortgage on the secondary mortgage market. And most of the time they do. Most of the time they do. That they make more money that way. They make money on the sale of that. And then guess what else they could do? They might get hired to be the face of the loan, to service the loan, to mail out or ship out your bill every single month, to be the customer service person on the other end of the phone. So they make some money that way as well, the lenders. All right, next in the new course syllabus is a brief talk about a short sale. So when it comes to a short sale is when the seller wants to sell the property, but they owe more on it, more on the house or property than they owe. So they're upside down in their mortgage is how we talk about it in the industry. This situation is considered to be a material fact because the property cannot transfer unless the seller gives permission. And the process for that can be quite long and arduous. Okay, let's see. A special note, this is new. Okay, let's look at this. We're talking about short sales still. Note, broker cannot negotiate a quote unquote workout agreement with the lender on the borrower's behalf because it would be unauthorized practice of law. You don't want to do that. Don't want to do that. Okay, let's keep going. So when it comes to selling property that has a loan on it, has a mortgage attached to it or deed of trust attached to it, what do we need to do? Well, the person who's buying the property more than likely would very much appreciate that lien being removed. And in fact, in the offer to purchase form 2T standard form, it says that the property will be transferred clear of all liens and encumbrances. And then it goes on to tell you a few exceptions, yada, yada. But right here, it tells us that we need to clear those liens. All right. But the new syllabus goes on to tell us that property that is being sold and it has a mortgage or deed of trust attached to it could be sold for cash. Maybe it could be assumed, the loan could be assumed. The property could be purchased subject to the seller's existing mortgage. That's a weird one. That one will, hold on, wait for it. Get you twisted up like a ding dang pretzel. Yes, it will. All right, guess what it says in the syllabus? Level 1. Okay, all right. So you could sell a property subject to the seller's existing mortgage. Could be a short sale. And then the syllabus is going to go on to go into general categories of mortgage loans. And we're going to talk about conventional loans versus FHA versus VA loans. And guess what? I have a graphic organizer for you. It's in Unit 15, in the Unit 15 folder, but it does not have an answer key. So I say, let's go ahead and fill it out together. So if you can find your graphic organizer for Unit 15, it's at the back of your supplementary materials called your sidekick. I'll pull mine up right here. And we'll fill it in using information straight out of the Real Estate Commission's vocal cords right there. So let's do it. Let me switch gears. You get yourself ready, and I am going to do the same. We're not going to start there. We're going to start down here with conventional loan features. So let's see here. The syllabus says conventional loans are typically seen as the most secure loans for lenders because they usually have the lowest loan to value ratio. Okay. Lenders like a low LTV, which would be 80% or less of the contract price or appraised value, whichever one is less. So a low LTV, you've got to think of it in terms of the lender, the bank. They want the borrower to put a good chunk of change down. That makes them feel secure. So they would prefer a borrower to put 20% down. Heck, they would like it if the borrower put, 30% down, 40% down, 50% down. They would love that. That would make them feel very, very secure lending money to this particular borrower. Okay, now let's see here. We've got a conforming versus non-conforming mortgage loans. Conforming means that we can sell this loan on the secondary mortgage market. So a conforming loan may be sold on the secondary mortgage market. And most lenders want that to happen. Most of them want to be able to sell the note on the secondary mortgage market. All right, let's talk about this notion of, let's see if it's down here. No. Okay, let's talk about mortgage insurance. Mortgage insurance is paid by the borrower to the lender for a high LTV. I hope that makes sense. What does that mean? That means that if the borrower can only put 10% down, the bank's not going to shoo them away. The bank is going to say, well, all right, but we really want you to get some insurance for that 10% difference in case you default on the loan. The insurance will make us whole. So the borrower will purchase that. It does go away at some point down the road when either the home appreciates in value or they paid the debt down enough that we hit that 20% mark. We make up that 10%. So it does go away, unlike some other mortgage insurance I'll tell you about in just a second. Oh, let's see here. So you could also, it says in the syllabus, apply for something called a home equity loan or home equity line of credit. Some people, I'm not going to put that here. Some people use that as a way to avoid getting mortgage insurance. Instead, they'll take out an equity line of credit for that difference, that 10%. Okay, well, amazingly enough, that's all we've got for conventional. Let's take a little time and move over here to FHA. All right, quite a bit of information here for FHA. Here we go. So FHA, that's the Federal Housing Administration. And if you want to find out more details, you can visit HUD.gov. And this loan program is operated by the Federal Housing Authority under the Department of Housing and Urban Development. And the purpose of an FHA loan is to make home ownership more accessible. Remember, this was the brainchild of President Franklin Delano Roosevelt when he was trying to get the country to recover from the Great Depression. Really, really fascinating history right there. So the purpose of the program is to allow for greater degrees of home ownership by requiring very little money down. So let's write that down. Requires very little money down. That means it has a high LTV. The government insures the loan. So the FHA insures lenders against loss if borrowers default. So the FHA provides insurance if the borrower defaults. FHA only insures the loan the bank or the lender makes up all other rules related to interest rate, points, origination fee, etc. Okay, let's make that say, we'll put I in there. Very good. That's important to know. That could be a really easy question that you answer correctly right there. Okay, let's see. All right, very good. So to get an FHA loan, you have to actually go see a lender, a loan officer, a loan originator representing a lending institution, just FYI. And let's see, so what else? The most common program is called the 203B. It's the most popular. And it applies to residential 1 to 4 unit property loans, including manufactured housing. That's great. You can get a fixed rate loan up to 30 years. Let's see, the FHA provides the mortgage insurance. Oh, here it goes right here. Let's define that. So the MIP stands for a mortgage insurance premium. What does that mean? So let's say, just for easy numbers, let's say that the down payment is 5%. It's really less than that, but we're doing easy numbers because you know how I am. All right, so let's say it's 5% down is what the borrower can do in this type of a FHA loan. Well, the lender wants 20% down. So the mortgage insurance premium, that's what it's called if it's an FHA loan, will provide insurance for the difference, for the 15%. So if this borrower defaults, then the mortgage insurance premium will make the bank whole. The situation with a mortgage insurance premium is that it never goes away. It's forever. Forever, ever. Yes, Ms. Jackson, forever, ever. Thank you, Andre 3 Stacks. All right, so let me go ahead and underline that, and let's write that down. Mortgage insurance premium is paid by the borrower forever. Forever. Nope, that's not it. Let's just write forever. Okay, forever. And interestingly enough, all of the folks who are getting FHA loans, they're paying this mortgage insurance premium forever. It goes into like this little bucket. And if there's ever a borrower that defaults, they just take the money out of that pool of money and fix it for the bank, make the bank whole. What else does it say about that in your syllabus? Okay. The borrower has to occupy the property, so it cannot be for, according to your syllabus, only for primary residence, not investment. Okay, there can be a maximum loan amount. Okay. All right. And of course, all of the interest rates and all that, that's set by the lender, not the FHA. We're going to have a special appraisal done. I'm going to move this information. Give me a second. I'm sorry if you're mad. If you already wrote that down, I'm going to put it up here. This is where it belongs. All right. What else? We're going to have a special FHA appraisal, which combines, adds in info about home condition. So when you have an FHA appraisal done, the appraiser is going to come out with a little checklist, and they're going to look to see, all right, what's the condition of this home? And it has to be, it has to meet certain minimum construction standards. And if the property has some flaws in terms of the FHA appraiser, those will have to be fixed before the FHA will insure the loan. And oftentimes, guess who's going to end up fixing that stuff? The seller, more than likely. Okay, but not always, but more than likely. There is no prepayment penalty with the FHA loan. There can be with the conventional. Let's put that over here. So we might have a prepayment penalty here. Okay. All right, an FHA loan is assumable. So it has no alienation clause or no due on sale clause. All right. Okay. Now, if a loan assumption takes place, then the original borrower could still be liable for the loan. Okay, so in a loan assumption, original borrower remains secondarily responsible for the loan. Yikes. Okay. And then over here, it tells us that there are other FHA loan programs that are available, including loans for special purposes like senior citizens, rehabbing a home, a condominium. You could have special loan repayment plans like a graduated payment mortgage, a GPM, or an ARM. So you could also get an ARM as well. All right, and Deb from the commission goes on to tell us that just have a cursory awareness that there are other programs out there besides the 203B. Okay, I'm feeling good about that. I'm going to clean this up for you as well, and it will be in your Google folder, a little bit cleaned up, like bullet points. All right, let's look at a VA loan. What's up with the VA loan? A VA loan is insured. Okay, so let's put this here. Let's do FHA insured loan. Said that. Insured loan, whereas a VA loan is guaranteed. Okay, and let's take the S off. Y'all are doing great. Okay, why? What's the diff? Not much. Not much of a diff. I asked Bill Troll, Duke Law grad, real estate attorney for a million years. I said, what's the diff, Bill? He said, not much, Cal. Not much. FHA is one governing body. VA is a different governing body. They just called it two different things. That was his explanation. He's a smart guy. So I'm rolling with that. That's what I'm going with. Okay. Here we go. Also, by the way, you could, if you want to visit benefits.va.gov/home loans, you could find all kinds of detailed information. These are great loans. All of these are, but VA loans are really spectacular. Why? Because you could get 100% financing or maybe even more. So when you're doing your 90-minute buyer qualification or buyer consultation is what I meant to say, meeting, you want to ask, could you qualify for a VA loan? You only have to serve in the military. I called about this one for a friend for 6 months, and you could be eligible for a VA loan. And in fact, that's what it's called. So when your borrower meets with you and says, yes, I could potentially qualify for a VA loan, you say, okay, we need to grab your certificate of eligibility. Certificate of eligibility is needed. Okay. And the purpose of this program was to allow our veterans greater access to home ownership after World War II. The VA loan was created as part of the GI Bill after World War II. All right, let's see here. The VA does not build housing or any of that. It simply guarantees, you might hear the term backs, it guarantees the loan against loss if the borrower defaults. And these are usually, again, residential 1 to 4 unit properties. It does include manufactured housing. So that's nice to know. And you've got to have that VA certificate of eligibility. Very good. And let's go over some characteristics now. All right. You may get 100% financing, so no down payment. They are assumable by anyone. That is a frequently missed question on my practice test. These loans are assumable by anyone, not just a veteran. All right, but watch this. Let's see how I want to say this. I'm going to say it out loud and then I'll type it. So essentially, let's say that a person who is not a veteran assumes the loan, assumes the VA loan. Then the current veteran who owns the home will not get their certificate of eligibility back, which they would want, I would think, in order to go purchase another home. So how do we want to say that succinctly? Oh, let's see here. Assumable by anyone, but veteran only gets cert of eligibility if assumed by another veteran. Okay, assumable by anyone, but a veteran, let's put a veteran, only get certificate of eligibility back if assumed by another veteran. Okay, that's good enough. All right, let's see. The property also has to meet certain condition standards similar to the FHA. It has to be for primary residence, not investment property. That came up in class the other day. That was interesting. There is no maximum VA guaranteed loan amount. There is a maximum with FHA. So no maximum loan amount. Okay. You've got very generous qualifying ratios. So the ones we learned about with conventional financing, let's go and write that down over here, would be the 28-36 qualifying ratios. But when it comes to VA lending, I mean, it could be 40 something, who knows? It's in your book, but it's not in the syllabus. Okay, I'm just saying. All right, here we go. When the, oh, I see. The VA loan may charge a funding fee. In fact, they will charge a funding fee. Funding fee paid by borrower. And I believe it says in your book, it could be anywhere from 0.5% of the loan amount up to 3-point-something% of the loan amount. That's a little detail you probably don't need to know. But a funding fee paid by the borrower, that is similar to an origination fee in conventional financing. It could be a lot, but guess what you can do? You can finance that too. That's how you can get 103% financing with a VA loan. There will not be a prepayment penalty. No prepayment penalty. What else? Okay. When the home is appraised, home receives a CRV instead of an appraisal, and that stands for Certificate of Reasonable Value. Okay. And all loans are assumable. Very good. I'll put that in there. Okay, great. Now it says, note, a VA release of liability does not release the borrower from liability to the lender. Lender must provide separate release for borrower to be fully absolved of all responsibility for an assumed VA loan. Okay, we kind of got to that topic up above. All right, very good. Next in the syllabus is just a wee tiny bit of information about a USDA loan. It's a level 1, so I'm going to tell you about it just a little bit. A USDA loan is provided by the Rural Housing Service of the Department of Agriculture, USDA. USDA can make direct loans sometimes, or they can, you can go through a lending institution. They guarantee single-family housing loans. They're generally targeted for low to middle kind of income rural land. Let's see, the repayment period is typically longer than 30 years, which I don't remember reading in your book. It says here it could be 33 to 38 years. You can get 100% financing. You can get subsidized interest rates, and the qualifying requirements could be a little bit looser as well. So these are great loans. Remember that they exist. Remember to check the eligibility map, USDA eligibility map. You just Google it, type in an address, and it will tell you if it could be in a USDA area. All right, next in the syllabus is a purchase money mortgage. A purchase money mortgage is seller financing where the seller acts like the bank. Seller acts like the bank. Very good. Remember that if there's a default, if the borrower defaults on this type of financing, the seller who's providing the purchase money mortgage may not file a deficiency judgment. Okay, very good. That's going to conclude this particular segment, I do believe, but let me double check our graphic organizer here. The next segment will go into different types of mortgage loans and some of those features. But let's go ahead and just finish up this graphic organizer answer key. All right, so let's go down here. What is the LTV formula? The LTV formula is the loan amount. No, I'm wrong. The LTV formula, I was doing PI by accident. Okay, let's get in there. Is going to be a percent of the loan amount. So usually a 2-digit percent. So I'll do, hold on, let's make that look like 2 digits. Percent of the contract price equals the loan amount. Let's get rid of that. Okay. Of means multiply. So you take the contract price, multiply it by the LTV, and that will get you the loan amount. Purpose of discount points. Give me a second. You know this, or you beat me to the punch. I bet you're trying to get ahead of me. Okay. Purpose of discount points is to buy down the interest rate for the borrower and increase the lender's effective yield or profit. That's what that means. Very good. All right, let's go over here. We did MIP. Let's talk about a certificate of eligibility and restoration of entitlement. We kind of discussed that up here. So a cert of eligibility must be provided by the veteran. Home must transfer to receive the entitlement back. Unless the loan is assumed by another veteran. Oh, no, that was good. Okay, I'm liking that sentence right there. Sort of a sentence. Nice. All right, y'all. We are just knocking it out of the park. Okay, let's go here. So conventional financing, do we have a typically high or low LTV? The answer to that is a low LTV. That's what the bank likes. Let's go ahead and highlight the answer. Nice. And how about this one? When it comes to FHA, is the loan a low or a high LTV? In this case, it's going to be a high LTV. And with VA, it's also going to be a high LTV. That's 100% financing. Very good. Oh, by the way, did you notice that with VA lending, you don't have to carry that mortgage insurance premium? I'm telling you, VA loans, they're kind of the thing. Oh, here we go. Oh, finance legislation. Let's take a quick pause and come back and we'll handle finance legislation. Did y'all get did you take a break? Did you get a protein snack? I need a protein snack. Boy, I tell you what, these finance units, whoo, they'll wear you out. Okay, because finance legislation is here, part of your graphic organizer, we're making an answer key anyway. Let's go ahead and knock it out. I had to skip a little bit ahead in the course syllabus, but you guys don't mind. So let me share my screen again. All right. Now, we've got some really nice information in here. To us, important note, pursuant to the Dodd-Frank Act, the Consumer Financial Protection Bureau, CFPB, was assigned the consumer protection responsibilities of 7 different federal agencies. Okay, so the CFPB is going to be over all of, or most of the legislation you're going to learn about here. So let's see. So CFPB oversees 7, count them, 7 different federal agencies, 7 different federal agencies. Okay, very good, including the Federal Reserve Board, HUD, the FTC. The CFPB is responsible for the rules, making sure the rules are enforced when it comes to the Truth in Lending Act, RESPA, the Fair Credit Reporting Act, and the Equal Credit Opportunity Act. It goes on to say, this is great background info, one express mandate of the Dodd-Frank Act was that the CFPB, the Consumer Financial Protection Bureau, consolidate the duplicate lender disclosures under TILA and RESPA, yielding the TRID rules. This is really Unit 21, but we'll talk about it here. TRID means the TILA RESPA integrated disclosure, and that happened in 2015. So let's go ahead and dive into the rules related to the Truth in Lending Act. Let's see what they say right here. The Truth in Lending Act, the rules are known as Regulation Z. So Regulation Z, let's just write this down, are the actual rules used to enforce TILA. Whoops, the Truth in Lending Act. Okay, that's good. So what else does it tell us? We have some rules known as Regulation Z. This is governed by the CFPB. Okay, so Regulation Z here is telling us that there are rules regarding advertising financing. So laws related to advertising loans. All right, here we go. So what kind of loans? Those that are loans that involve a finance charge and or are payable in more than 4 installments. What does it say? It says that if certain information is shared in an ad, then the lender has to disclose certain information as well. Okay, so let's see here. Very good. Okay. So if an ad, let's see. When an ad uses trigger terms, the 4 chief disclosures must appear in the ad. What are the 4 chief disclosures? Let's go. Number 1, the APR, which is the annual percentage rate. That is not the interest rate. Let's say what it is. The annual percentage rate includes finance fees and the interest rate. So the APR is usually a smidge higher than the actual interest rate that's quoted. All right, so that's 1, the APR. Number 2, finance charges. Number 3, amount financed. And this could be, well, I guess that's fine, amount financed, and then total amount of all payments. What you don't need to disclose, let's do a little asterisk. I got this on a PSI practice test. No need to disclose prepayment penalty clause. What was the other one? Prepayment penalty clause. Oh, I found it. Or rebates. Okay, very good. What else does it tell us? Let's see. Okay, so This rule is going to, listen to this weird language. This rule applies to creditors and or, watch this, and or, look at this language, arrangers of credit. What the heck? That's just another term for, I put down that it's synonymous with an originator, a loan originator, but arrangers of credit, never heard of that. That showed up in an exam. I might just lose my mind. Never heard of that before. Okay, let's see. Okay, very good. Apparently, this could also apply in lease situations. The advertising. I know, it's not in your book, but it's in the syllabus. So it could apply to the lease agreement as well. Okay, let's go over to the Real Estate Settlements Procedures Act. Actually, not a lot about that here. It's going to show up more in Unit 21, so keep this for Unit 21. But the Real Estate Settlements Procedures Act governs, how do I want to say it? It's really transparency. So it governs, let's say, disclosures on settlement statements. Like what? All money related to the transaction must be disclosed on the closing disclosure or the settlement statement. Could also be called the HUD-1. So just so you know that. So all money is associated with that. RESPA also says no kickbacks allowed between settlement providers. Settlement service providers. Well, who are they? Those guys would be home inspectors, attorneys, bankers, real estate agents, etc. Okay, so this means that, let's say that I have a whole bunch of my clientele happen to use one particular home inspector. That home inspector can't cut me a deal and say, hey, Kelly, for every buyer you send my way who buys a home inspection from me, I will send you $20 as a thank you. I will kick you back $20 as a thank you. That, my friends, is against the rules. That's a no-no. So that's what that means. Now, the one about the real estate agent is just that. So that's a real estate agent and an attorney, a real estate agent and a lender, a real estate agent and whomever. The one exception to this kickback rule with RESPA is real estate agents can do referrals with one another. So that is okay. All right, so that's RESPA. Let's go over here. Let's talk about ECOA and the Fair Credit Reporting Act. Not a lot there. Okay, hold on one second. All right. So ECOA stands for the Equal Credit Opportunity Act. I got a funny question about ECOA, but let's go. We'll start this. We'll start here. Okay, protects. Let's talk about the people. Protected classes from credit discrimination, from lending discrimination. Okay, who are the protected groups? Let's see, it's going to be race, sex, religion, color, national origin, 2, 3, 4, 5, plus marital, no, plus public assistance, marital status, and age. What does that mean exactly? Well, ECOA was passed in the 70s. And so back then we had the Fair Housing Act of 1968. And by the time ECOA came around to be passed regarding anti-discrimination in lending practices, race, sex, religion, color, and national origin were the 5 protected classes at that time. Later on in 1988, familial status was added and handicapping condition. But these are the protected groups for ECOA. And ECOA in the 70s, early 70s, added anyone on public assistance may not be discriminated against. In fact, if you're on disability, that disability can be seen or used as your income. Marital status. So back in the olden days, due to the laws of coverture, I'm just showing off with the history. Due to the laws of coverture, women did not have any type of identity in the world of finance. You were just kind of, related to your husband. That was it. So you couldn't get your own credit. You couldn't buy your own car. You couldn't buy your own house. They wouldn't lend to you as a woman, a single woman. You had to be married. And then age. So they added age on there. So if my 80-year-old mother could qualify for a home loan, 30-year fixed rate mortgage, they couldn't discriminate against her based on her age of 80, believe it or not. All right, so that is the Equal Credit Opportunity Act. The Fair Credit Reporting Act. Wait, hold on, I wanted to add something to it. Okay, here was my PSI question. Credit may be denied if applicants' main income is commission-based. That's risky to a creditor. They don't like that. Okay, if credit is denied, applicant must be informed within 30 days of reasons. Okay, so why? Why did you deny the credit? All right, very good. Anything else there? Nope. Let's go ahead and write down the Fair Credit Reporting Act. And it says now that people are allowed to refute any potentially false claim or false whatever against their credit. So you can write a letter and refute that. You have a right to, let's see, people may view a credit report one time per year for free. Is that it? Something like that. Okay, I can live with that. All right, team. Let's see if there's anything else on here before we call it a session. I'm going to scroll up. So avert your eyes for a second. And let's go up to the top. We might as well just finish this thing. Okay, here we go. Let's take 3 seconds and then you can really take a break. It's 5 o'clock somewhere. All right, the purpose of the primary mortgage market is to what? Originate loans. Remember, this whole financial system was set up during the Great Depression when Franklin Delano Roosevelt, former President Franklin Delano Roosevelt, was trying so hard to help the economy recover when we had a 25% unemployment rate. And so he put his cards in the housing market. So when he was trying to get more people in homes, that would cause more homes to be built. It would get people back to work, yada, yada. Okay, so the purpose of the primary mortgage market is to originate loans for the people. Come on, for the people, for the masses, let's go. Purpose of the secondary mortgage market is to buy loans from the primary mortgage market which infuses capital back into the primary mortgage market. Watch this, it's gonna get real wordy. Allowing banks to originate even more loans to the people. You get the idea. We want that flow of money moving in a circle. Let's keep the economy going. Let's keep that money flowing. That's what we want to see. Whew, that sure was a doozy. I hope you got a lot out of this review. The finance units, we've got 12 questions apparently on PSI national. So six out of each unit. We're going to come back for another review session. It's probably going to be another hour-long review session because these units are very dense. So thank you for being here. You've got this. It's us against the test. Who's going to win? We are, because what? All we do is win, 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 no matter what. All right, listen, click subscribe if you want the latest updates, and I will see you for the next review session. Keep studying.